Why do people use candlestick charts over normal charts? Let's find out what candlesticks are and how to read them. The law of supply and demand is one of the fundamentals of economics and describes the relationship between buyers and sellers through the price. You might have heard about the supply versus demand rule, but something you may not be aware of is how demand itself is strongly influenced by emotions, namely fear and greed. Candlesticks originated in Japan, and their purpose was to create a visual representation of the emotions of the traders in the rice market. A candlestick can be used to represent a value, for example the price, during an interval of time, be it 1 second, 1 week, 1 year, depending on the purpose of the chart, and it shows not only what happened in that particular interval, but also what is likely to happen in the next one. The first thing we observe about a candlestick is the color. Here, a candlestick can be either green or a bullish candlestick, which signalizes that over the selected interval the price increased, or red or a bearish candlestick, which signalizes that the price dropped. The colors can vary. Green and red are just the most common ones. We also notice a candlestick consists of two parts, the body and the wicks. The body represents the price range between the opening price and closing price for the day, while the wicks show the highest price and lowest price registered for that same day. For this green candlestick, the bottom shows the opening price and the top shows the closing price. For a red candlestick, the meaning is reversed. The opening price is on top, while the closing price is at the bottom. When taken individually, a candlestick provides information about the price specific to the selected interval. However, when looking at it in the context of a graph, it can predict what the most likely color and shape for the next candlestick is. We'll now use a chart to put some of the most important types of candlesticks into perspective. In our example, the opening price for the next candlestick is equal to the closing price of the current one. Here, the next candlestick is a red one, with a lower wick. This means that the closing price is also the lowest price for the entire day. In other words, there was no price rejection at any moment on the downside. The selling pressure still exists, and there's a good chance for the price to further decrease and for the next candlestick to be also a red one. A distinct type of candlestick is the one without a body. They are called doji, or, based on the trend, morning star for the downtrend and evening star for the uptrend. These types of candlesticks are showing that the chances are high for a trend reversal. The last type of candlestick we're covering in this video is the bullish or bearish engulfing candlestick. In our example, the green body is engulfing a small red body, which is a bullish signal. This means that the buyers took control over the market and the upcoming candle will most probably be another green one. In our previous examples, the closing level for a candlestick was always equal to the opening of the next one. However, the stock market not being open 24/7 means gaps can occur as a result of extraordinary buying or selling taking place while the market is closed. If a report with unexpectedly high earnings comes out after the market has closed for the day, a lot of buying interest will be generated overnight, resulting in an imbalance between supply and demand. In the morning, the price of the stock rises in response to the increased demand from buyers. If the price of the stock remains above the previous day's high throughout the day, then an up gap is formed. Although not a rule and some people also disagree with it, there is a tendency that the future candle, so not necessarily the directly next one, to fill this gap, even if only with a wick, so the price will most likely revisit the close before the gap. If you like this kind of content, don't forget to like the video and subscribe to our channel.